Welcome to the live economic and financial markets commentary. This live session will cover fundamental analysis in the week ahead, global coverage of current economic data, including major markets news, analysis, and events, how to apply the best trading strategies prior to news being released and after. First, I'd like to start the session by giving you some information about me. My name is Ihab Jubil. I was born and raised in Egypt. I have a passion for financial trading as well as teaching. I have been trading for a number of years, mainly on Forex and commodities. And in recent years, I have also set up my own trading robot signals and website. I host online webinars and seminars on investment and financial trading regularly, and I provide my service to subscribers worldwide. Now, let's start the session. Commodity currencies staged a strong comeback last week, and stocks extended recent rebound. Dow Jones closed the week at 17,084, up 612 points. S&P 500 closed at 2,014, up 143 points. Commodities also performed well, with gold up slightly at 1,156, but managed to stand above 1,150. Crude oil's rise was more impressive as it broke out of recent range and reached 50, handled to 50.9 before closing on Friday at 49.5. While Canadian dollar was lifted by strength in oil prices, Australian dollar ended as the strongest one as RBA maintained a neutral stance rather than turning dovish on recent developments in China. Meanwhile, yen was the weakest major currency on risk appetite. Dollar followed closely as traders were getting less and less convinced of a December federal rate hike. There were a number of central bank activities last week. The FOMC minutes for the September meeting unveiled that concerns over the global economic outlook had made policymakers decide to keep rates unchanged. They believed it was prudent to wait for more information to confirm that the economic outlook had not deteriorated, and that inflation would gradually return to plus 2% over the medium term. Some federal members suggested after the meeting that a rate hike decision was a close to call. However, we don't get such feeling after reading the minutes about that. We saw some participants were considering raising the policy rate by the end of this year rather than in September, in order to emphasize the worry over the global economic outlook. The minutes even added a risk statement that recent global economic and financial developments may restrain economic activity somewhat and are likely to put further downward pressure on inflation in the near term. Similar to the Federals, the ECB minutes for the September meeting showed that the policymakers were concerned about the global economic outlook, especially slowdown in China and other emerging markets. The Governing Council generally agreed that down side risks to Eurozone's recovery and inflation have increased as a result of lower commodity prices. A stronger euro and a lower growth prospect, the central bank repeated that the monthly asset purchase of 60 billion euro would be fully implemented until the end of September 2016 and beyond if necessary. Same as August and September, the Bank of England voted 8-1 to keep the bank rate unchanged at 0.5% and decided to leave the asset purchase program at £375 billion. McCaffrey remained the only member favoring a rate hike. He suggested that the likely prospective increase in domestic costs was sufficient to satisfy an immediate increase in bank rate. The Bank of England now expects inflation to rise more gradually than it stated in the August inflation report. This is probably an indication that interest rates would stay low for longer. RBA kept the cash rate unchanged at 2% in October. The statement contained a few changes, suggesting that policymakers' view on the economic outlook stayed largely the same as the previous month. The updates, however, indicates that the central bank has turned more confident over the growth outlook. It also hinted that more measures have been implemented to contain the housing price surge in Sydney and Melbourne. We retain the view that the RBA would leave the monetary decision unchanged for the rest of the year. Bank of Japan left monetary policy unchanged as expected. Interest rate was held near to zero, while the target for monetary base expansion is kept at 80 trillion yen annually. Most importantly, the central dropped no hints on further easing in last week's statement. Bank of Japan noted that Japan's economy continues to recover moderately, although exports and production have been affected by the slowdown in emerging economies. This week, we will watch these events in all times are London times. Tuesday 13, 9:30. Tomorrow, UK CPI yearly release. Wednesday 14 at 1:30 p.m. US core retail sales. Thursday 15 at 1:30 a.m. Australian employment change. At 1:30 p.m. US core CPI. And at 10:45 p.m. New Zealand quarterly CPI. And I will talk in more details about some of this news. UK CPI will be released on October 13 at 9:30 a.m. London time. UK CPI release should provide some directional movement for the pound, as CPI should directly affect the short-term direction of the currency and, in extreme cases, long-term monetary policy for Bank of England. It's forecasted at 0%, exactly as previous release. How we will trade this news? We are looking for a variable deviation of 0.3%. If the inflation number remained above 0.3%, we will buy the pound. If the inflation number decreases to -0.3% or less, we will look to sell the pound. And even with a slight difference of 0.1%, market usually overreacts and we can see more volatility. If our deviation is hit, there is strong possibility that the market will move more than 50 pips immediately. In the event that we don't get our deviation, we will be looking for an after. If we get our deviation, we will look for the after news retracement trade. We will wait for the deviation and then we will wait for the market to move first with momentum and wait for a decent retracement before entering the market and buying the option or placing our trade. But if we don't get the deviation number, I expect the market to follow the pre-release market condition and sentiment upward. If the market follows the trend as in this chart of the pound dollar 1 hour chart that you can see. So if we get our deviation, so we'll buy the pound at 0.3%, sell the pound at minus 0.3% or worse. If not, we will just follow that trend and we can see the trend here in the chart upwards. US core retail sales will be released on October 14 at 1:30 p.m. London time. US core retail sales is usually a good market mover, and considering recent dovish tone out of the Federals, a stronger retail figure may help to boost market sentiment and support the dollar. It's forecasted at minus 0.1%. It was previously 0.1%. The plan to trade this news is it's just straightforward. We are going to wait for 0.4% release or better to buy the dollar, or minus 6% or worse to sell the dollar. If we get in between release, we don't get our deviation number, we will need to look at the pre-release market condition and sentiment in order to make a decision, or just stay out of the market altogether. We will trade this news release using after news retracement method as usual. I will pay also attention to both headline and the core retail sales figures, but my focus will be on the core figure. So if we don't get the deviation number, I expect the market to follow the pre-release market trend. As we can see at this hourly chart of euro dollar, there is an upward trend. Australian employment change will be released on October 15 at 1:30 a.m. London time. Australian employment change release will be the catalyst for Australian dollar in the short term, with Chinese economy showing signs of slowdown. Even a strong figure today or this day will not support Australian dollar for long. It's forecasted at 7.2%. Previously it was 17.4 thousand. Forecasted at 7.2 thousand or 7,200. Previously it was 17,400. To trade this news, the deviation that we are looking for is at least 25,000. Usually from 25,000 to 30,000 of difference has produced more than 50 pips of movement in the direction of the difference most of the time. Expect to see the effect of this news to last minimum 45 minutes to 2 hours. One other important news to pay attention to is the unemployment rate, which is expected to drop to 6.2%. If we don't get a conflict with the employment change, then we will proceed with our trading plan. We will buy Australian dollar at 32,000 and we will sell the Australian dollar at minus 17,000 of exchange. If we don't get the deviation number, I expect the market to follow the pre-release market trend, and according to the recent movement of the market, as a chart, if this trend lasts till the time for the release of the news, the market would expect it to move upwards. New Zealand CPI quarterly will be released on October 15 at 10:45 p.m. London time. New Zealand CPI is quarterly release. Therefore, there is a chance for the forecast to miss, and considering that the disinflation theme in global, there are very little expectations for a strong surprise. It's forecasted at 0.2%. Previously, it was 0.4%. Our focus will be on the headline CPI number. If we get a better release of 0.5%, we should be looking to buy the New Zealand. If we get a lower release, 0.1%, then we expect to see the New Zealand dollar moving down. Usually, if our buy or sell figures are hit, we could expect the market to move more than 50 pips within the next hours. We will be looking for an after news retracement trade also for this release. If we don't get the deviation number, I expect the market to follow the pre-release market trend as usual. You can see this chart. This is 30 minutes chart of July release of New Zealand dollar during and after the news release. And because the deviation number was not hit, we did not see any new direction of the market, and the market just followed the pre-release market condition and sentiment downwards. It's very easy to trade the news. So then I would like to thank you for attending today's webinar. We will hold following webinar next Monday. Goodbye and see you next time.